Allocating the value of the acquisition into goodwill. In a business combination, when a parent company acquires control over a subsidiary, the acquisition cost must be allocated to the identifiable assets acquired and liabilities assumed at their fair values. Any excess of the acquisition cost over the fair value of the identifiable net assets is recognized as goodwill. Goodwill represents the future economic benefits arising from assets that are not individually identified and separately recognized. It typically includes factors such as brand reputation, customer loyalty, employee expertise, and synergies expected from combining operations. The allocation process begins by first identifying and measuring all tangible and intangible assets and liabilities of the acquired entity at their respective fair values on the acquisition date. Examples of tangible assets include property, plant, and equipment, while intangible assets may include patents, trademarks, and customer relationships. After the fair values have been determined, the next step is to compare the total acquisition cost, which includes the purchase price paid, any contingent consideration, and direct acquisition-related costs if applicable, to the fair value of the net identifiable assets. The fair value of the net identifiable assets is calculated by subtracting the fair value of liabilities assumed from the fair value of identifiable assets acquired. If the acquisition cost exceeds the fair value of the net identifiable assets, the difference is recorded as goodwill in the consolidated statement of financial position. Goodwill is classified as an intangible asset and is subject to annual impairment testing rather than systematic amortization. On the other hand, if the fair value of the net identifiable assets exceeds the acquisition cost, the acquirer recognizes a gain on bargain purchase immediately in the profit or loss statement. It is important to note that the allocation of the acquisition cost to identifiable assets and liabilities must be done with great care and based on appropriate valuation techniques. Mistakes in the initial measurement can result in material misstatements in the consolidated financial statements. The proper recognition and allocation of goodwill are crucial because goodwill often represents a significant portion of the total assets in many acquisitions. Its impairment can have major effects on future earnings and shareholder perceptions. In summary, allocating the value of the acquisition into goodwill involves identifying and measuring all identifiable assets acquired and liabilities assumed at fair value, calculating the fair value of the net assets, comparing the acquisition cost to the fair value of net assets, recognizing any excess as goodwill or, if applicable, recognizing a gain from a bargain purchase. By carefully performing this allocation, companies ensure compliance with accounting standards such as IFRS 3 business combinations or related national standards, and they provide stakeholders with a transparent and accurate view of the economic impact of the acquisition.